Hey YouTube, this is Zach with Achilles Financial, and I am super excited to be talking about the STEM earnings. They announced Q2 results today, and we will be reviewing the press release and seeing how that compares to some of the other presentations that they've provided. Overall, I was incredibly satisfied with the results that they announced, and I thought the earnings call went incredibly well. It reaffirms my capability or my fortitude for wanting to hold the company's stock. Keep in mind that I am biased as we go through this, as a substantial part of my portfolio is in this company. I think that there is a lot of great things going for this company, and as such, I will hold on to that bias. Also, keep in mind that I am by no means a financial advisor, and anything I say today is strictly my opinion and should by no means be constituted as financial advice. So let's talk about the company today. So this is STEM, and they had their Q2 earnings as of June 30th, 2021. So these numbers are right at 2 months old or a month and a half old. The important things to note, I'll highlight that here in their financial highlights, is that revenues are up significantly, and that is up 339% from the year before. I'll have the link, by the way, to this entire press release in the description down below, so I'm not really just going to read everything step by step. The important thing to note here is they were forecasting 5 to 15% of their total revenue to come in Q2 of this year. So in Q1 of this year, they brought in $15.4 million. In Q2, they're bringing in $19.3 million. In the last video that I had, we were highlighting we expected that to be between 18 and 19, so they beat my expectations. And I think that this is spot on. So the fact that we've had 2 consecutive beats is either A, going to allow the company to have some wiggle room to come in on the low end of their estimate, which they still believe is going to be right at or right in line with prior guidance, and they're going to be able to come in on the lower end, or if they come in on the higher end, it could allow for a full year beat. Now, some of the other things that were pretty clean or looked very nice is you can see that the gross margin here is coming in right at a negative 1%, so they're still losing money in terms of doing the business. What I like about that right there, you can see the year-over-year decrease in that expense, but what's kind of more exciting or provides more capability for the company to grow is the fact that with each consecutive quarter, that loss is decreasing, and that's really what we want to be looking at, is those gross numbers, because that's actually representative of the business itself with those variable costs to produce the cost of goods sold. So we need that to continue to go down. A huge portion of that is going to come from, going forward, the revenue that's going to be coming in from the software side of the business. That is a recurring SaaS-based model, and so that's going to be very little overhead, which will bolster those margins. Right now, we're going to be a lot more heavily weighted towards new business coming in directly from the hardware side, which is where a lot of your cost is going to be, particularly while they're not able to grow at scale right now. The large concern this quarter is once again going to be that net loss of more than $100 million. We'll talk more about that. The key reason behind this is due to the fair value valuation associated with warrants, and we'll go more in depth there. So they did lose another $8.6 million when you look at the adjusted EBITDA. That total for this year, the expectation is for that to be negative $25 million, and they seem to be closing in or right spot on that number as of right now. Again, they are sitting on a huge cash pile that is sufficiently associated with the investment coming from their SPAC deal, and they still have zero debt, which I think provides them a lot of leverage. Again, you don't necessarily want the company to take on debt, but if they can take advantage of some of the very low interest rates to fund their growth that way at a 3% debt issuance versus going out and getting additional capital by offering additional shares, that would be my preference. As a shareholder, I would prefer that, because I think that you are capable of bringing in a lot of money right now by issuing debt offerings such as bond offering versus going out and issuing additional shares. So the operating highlights, this first item right here, 12-month pipeline, is totally useless, because this is no more than saying, hey, we've identified a client to potentially do business with us. So that number means nothing. I don't like that they've included that in here, and feel free to disregard that if you see anything on Twitter or other YouTube videos talking about this number. This is strictly, and labeled down below, their Salesforce pipeline saying, hey, this is identified clients. What is a lot better is the fact that their contracted backlog is now up to $250 million in total value, up from $221 million at the end of the first quarter, which means that they brought in or delivered on $19.3 million of revenue here at the same time that they were bringing in another $29 million. So that means that they net positive over the course of the quarter. We'll call that right at $50 million in total new contracted backlog or new revenue that's being brought in. The other thing I want to highlight is that contracted assets under management, AUM, of 1.2 gigawatt hours, up from 0.5 last year. So that's not a huge increase from the Q1 number, but what's important to note here is that this number right here, basically we can think of this as they are managing real estate. The more that they bring in here, the more is going to be, technically speaking, under their SaaS-based model, the more the merrier, and the company is going to continue to grow there. So there was a lot of great things to talk about for the company, but let's continue kind of highlighting some of those results. You can see this compared year over year. I really want to get excited about the 2020 to 2021 numbers, because I do think that this growth is fantastic, but they also got a huge injection of cash. So what I'm going to continue to look for is how well did the company, or how well will the company do here in September or Q3, because that's when we really start seeing the big numbers come in. So this quarter we should see really double to triple the numbers that we saw this quarter. So I'm looking for 35 to as much as $55 million in Q3. So you can see here that the big loss, again, coming from this number right here, 100 million. We'll talk about those warrants as well. So as we just go through here, again, there's a lot of nice things to highlight here. It's really going through what we were looking at earlier. The big things that I want to highlight is they are growing very quickly on the East Coast compared to what we were looking at was mostly in California at the beginning of this year. So you can see that we are growing in Massachusetts, a lot of the New England area. And what I want to highlight, or what we're seeing is really hurting, is this capability right here for the stock valuations of those private warrants. So keep in mind that they did issue warrants as of the share issuance when they were talking about the SPAC merger, and that is what's going to continue to have downward pressure on the overall stock price, because there are still, as of today, 12.8 million public warrants outstanding. So I don't know what the price on those warrants are right now, but the way that a warrant works is that, generally speaking, it acts like a call option. So if the price is over a certain point in time, the investor has the capability to purchase the stock at the price that the warrant guaranteed. So if the price on the warrant was $10, right now, those stock price, or the stock price currently sitting north or at $27 a share, means that they could exercise that warrant and get the stock, for which they may have paid 50 to 75 cents for. They could get that stock now at $10 a share, which means that that share has to be issued to them despite the fact it's currently going for $27 a share. So the good news is these are redeemable by the company as of August 20th, 2021. The important thing to note is the company going to begin purchasing back those warrants and contracts? If they do, that means that they think that their stock is a good investment at those levels. If they do not, that could be cause for concern, because that means they're saying, hey, we think the stock price is overpowered at this point in time. The big thing, or the great news that we see here, is that they have reaffirmed its guidance of full year 2021 revenue. The big picture that I want to highlight here is this means that after 2 quarters, and again, we're going into August, so we've already a month and a half through Q3, they're saying, yes, we're going to hit the goals that we stated previously. There have been a lot of SPACs that have not been able to do this. You've seen that repeatedly, where they've had to change their year-end outlook, and it has slaughtered the stock price on those particular companies. So the fact that they're reaffirming that full year guidance is not only great, but it provides us as investors some clarity into the future that, hey, they've already closed about $35 million in revenue for the year. And because of that $35 million, we can expect right at another $110 million. And again, I think that they are primed to potentially have a beat for the end of the year. Right now, we're still looking at right at 35x sales to price to sales from the current stock price to the overall valuation, which is incredibly high. However, if they triple the total sales from where we're at today of around 50 million to 147 million in terms of trailing 12 months, then that 35 price to sales then becomes 15 price to sales, which is still relatively high, but a lot more attractive. And for that reason, I think the stock price can continue to grow. The one concern is, and this is in line with their guidance from their very first presentation ever given, was the full year adjusted EBITDA, earnings before income taxes and depreciation, is still negative 25 million. They are not expected to have net profitability until 2023, although they do expect profitable gross margins in 2022. So the item here is, again, the company reaffirming it does expect to meet its 2021 revenue goal, and it will continue to diversify the supply chain and whatnot. The reason I do highlight the diversified supply chain, their key investors or key battery makers is primarily LG. Tesla is also another huge battery maker for them. And so for them to make sure that they're getting all of their appropriate data and everything going on with all of the supply chain issues this calendar year, it's nice to see that they recognize that. Some of the other items I want to highlight here as we talk about the company, if we look at their total assets, it's very, very attractive to see this high of a cash balance this calendar year. And for that reason, I'm always going to laud the capabilities that they have to go out. I think that they have the capabilities to make strategic acquisitions or continue to reinvest into the company organically. There's a lot of prime areas or associations for growth at this point in time. The liabilities that worry me are not necessarily what we see here, because again, there's nothing crazy that I say, hey, this is wrong or worrisome to me. But rather, when we go down here into kind of some of those longer term liabilities, it's this warrant liabilities right here. So again, there is this significant capability of, hey, we still owe this money. And for that reason, those warrant liabilities are going to continue to be a very strong issue of consternation between the company and those warrant holders. However, this will pay off over time, especially with the company being able to start making those purchases back as soon as next week. So we'll continue to kind of scroll down here. Again, the big thing to note here is that for the actual gross margins, the company is still losing money on their product. However, I do think that as that scale increases, as well as the services continue to get larger, you'll continue to see this go positive. And this could happen as soon as this calendar year. The reason I say that is because, again, the EBITDA right now is pretty close or pretty in line year to date with what we came to expect or what was told to expect in terms of their growth going forward. And as we go into the condensed consolidated statements of cash flows, you can see here we've got that net loss. This is all of the other additional information that we see available here, with the vast majority of that net loss coming from that change in fair value warrant. Again, recognizing that there's still, from operating activities, coming in at a negative 41 million, because there is still a lot of growing pains is what I'll highlight there. But the big one is still, we've got that negative, or that 133 million coming from the warrant capabilities there. So last but not least, you can see that on the year-to-date basis, we're coming in right at $12.6 million for the adjusted EBITDA. On the negative side, the expectation this year is going to be negative 25. So we do expect that this is going to be much stronger going forward. Some of the things that I want to highlight here is we do have that stock-based compensation here of $1.7 million. I think that this is going to continue to grow and could grow pretty rapidly. For that reason, that could be a cause for concern of, does management warrant the capability to continue to get these massive stock-based compensation rewards and when the company is still not turning a profit. So that's what I'm going to be looking at, because I will be somewhat frustrated if management cashes out with $25 to $35 million this year when the company as a whole is not making nearly that much, especially on the profit capabilities. So you can see the final information here. Once again, I'll reiterate the pipeline number right here this is the total value of uncontracted potential hardware that is currently in process from Salesforce. So again, or their direct Salesforce. So again, this is just a made up number. I can identify clients there. The one that's much more important is this bookings value that we have right here and the contracted backlog. So this is the information that they came out with today. I want to compare this to what we saw from their original presentation. So what I have here on the screen, this is the original presentation that was done or redone for the March 22nd, 2021 Simmons Energy Conference. So this is not the one that was produced in January. But I do want to highlight that right now they are still, their contracted backlog has grown like we saw to north of $250 million in total contracted backlog, which is huge because they've continued to deliver. The revenue target has stayed the same, the EBITDA target has stayed the same, and they've, over these 2 quarters, beat on the Q1, or rather they were on the high end. Q2, they were on the high end. So we're at about $35 million approximately in terms of total revenue. However, that means we've got some huge revenue numbers still to come in Q3 and Q4 of this calendar year that we've got to be watching for. But the thing that I want to continue to highlight is we are steadily growing in line with management expectations. So the goal here is, will this continue to grow at the same rate? So you're seeing this by segment, but the important thing is 147 million to doubling again in 2022, with again a very similar amount from the overall services side going from one segment to the other. Overall, we are seeing significant growth over by the segment by segment that you can see here. We want to see those numbers continue because if they do, again, that is higher margins for the overall company. And you can see that those expected gross margins can continue to grow here. So the expectation here is that we've got that gross profit here of 24 million. Overall, the company will not be able to achieve that this calendar year in terms of net profit, but the expectation here is as a business segment, they will be able to turn a profit in terms of that gross, not the net. So overall, I think that this is huge for the company going forward. Again, I am a big bull associated with them, but you can see right here in terms of their expectations going forward, they do look set to hit that negative 25 for the adjusted EBITDA. We'll see about the adjusted gross profit. I think that's going to be tight. It's going to need more information on Q3 and Q4. The 147 is still in line, if not capability to be beat. And I do think that we're going to see this free cash flow will come in at that pretty big negative number, largely due to probably some of those warrant buybacks and whatnot. So all this being said, I thought this was a great earnings for STEM. They came in on the higher side of revenue. There weren't really any surprises. They reaffirmed full year guidance. So I'd say overall it was kind of ho-hum. This is expected. A high-performing company is high-performing. The big thing is going to be what happens here in Q3, what happens in Q4. Do they crush those huge numbers that they've set those goals out there for? For that reason, I will continue to buy into the stock. This is a company I talk about on a weekly basis, whether it's on the channel or in the Discord in the comment section down below. Looking at the numbers here on the screen, if they ever hit revenue of $1.1 billion and they're having right at 25% of that or a third of that coming in at free cash flow, that is huge for the company. There's still going to be growing pains along the way, but this is a stock that I could see someday being at $200 to as high as $400 a share. And for that reason, I'm going to continue buying in at these levels. So if you have any other questions, feel free to drop those in the comments section down below or in the Discord. And if you find this type of content helpful, please leave a like and subscribe. Thanks, everyone. Talk to you later.